Now, is it possible to have an informed opinion about market direction and market behavior without being counted as either a perma bear or a perma bull? Yes, I think so. And that will be the focus in these videos and here at Paleo Trading and Paleo Capital. We believe in price behavior and on being on the right side of it. And that's everything actually that you need to know. Because I don't think you can separate an opinion about the market from your time frame and what you're actually doing with your investments or trading decisions, the time frame that you're operating in. And that's what's necessary. Now, a little bit about myself. My name is Carl Oskar Ström. I'm a Norwegian. This is the first video that we do of this format in English. I've been doing it in Norwegian for several years with weekly market updates. But now I've left the financial industry after having worked there for 25 years in everything as a trader, proprietary trader, stockbroker for many years, handling both retail and institutional clients. And I've worked developing several online trading systems that you guys out there are using every day, be it if you're a small investor or a large, using the direct market access and algorithm trading systems. So and now I've left the industry. I've published a book just last week on Amazon, Paleo Trading, how to trade like a hunter-gatherer. And we start this YouTube channel with some weekly or semi-weekly updates whenever I find something interesting to comment in the market. I'm also in the process of launching a hedge fund that will trade the Nordic markets and selected European stocks, mainly the tech industry. And I guess close to half of the trading will be in US indices and in the US stocks that I've been following for several years. We'll trade stocks, derivatives, etc. I can see from the online community now that hedge funds are very popular, so I guess there's always room for one more, be it a very small one. But anyway, if I talk about positions, specific positions in the market in these videos, it might be positions that we have ourselves. I will let you know if we do. I'm not a big fan of disclaimers. I believe in freedom, and I believe you guys out there can form informed opinions of your own. But just to be clear, this is no recommendations. We're just talking about interesting topics and ways to address them, and that's the focus of my book as well. I think it was okay to write a book, actually, to do it in a long format. The first chapters is about practical lessons from being on the inside of the systems that you are using for several years and seeing various market participants' behavior, because you can see their tracks in the market, just like you can see the tracks from an elk or a deer in the snow. And being a hunter, being a trader, you can follow these tracks, and it might lead you to situations that you can profit from. So that's the first part of the book. The second part of the book is what I like to call a cookbook for traders, which picks up the trail where a lot of other books in this genre trails off. And that is what to specifically do and when to do it, how to address the various setups, starting with very short-term intraday trading, then moving to overnight trading, then to the classical swing trading setups, and ending on elaborating on what I call asymmetric opportunities that happens from time to time. So I don't expect to get a Nobel Prize in literature for this book, but I do expect it to be a good tool for you guys out there to handle your own positions in the market. Now, what's the general status of the market right now? Well, I think we can say for sure that we are not at the bottom. But whether or not we are at a top or the top, that's something completely different. And what I can see from the technical behavior of the market, we don't see any technical selling signs. Yeah, I know it's been a couple of red days on the Nasdaq, but all the moving averages defining the trend are still intact and have not come into play. Comparing this situation to the one I've seen before, I've lived through the end of the 1990s, the IT bubble, and where Nasdaq actually had some very, very strong years, as we all know, leading up to the top in 2000, and then we had a couple of very hard down years again, and the index from its top to its bottom in 2002 actually fell 83%. So all you guys out there touting how good it is to always invest in index funds, etc., the Nasdaq 100 index fell 83% from top to bottom. So if you have even the slightest amount of leverage in your portfolio, you'll be wiped out. And otherwise, if you start with 10 million, you're left with 1.7 at the bottom. So how to avoid that? Well, you have to have perhaps a more diversified portfolio, but everything kind of moves in lockstep right now. So what you need is a strategy for following up your investments and having a plan B in place when things turn south, which they eventually will. But not right now. I think if we are entering a topping process, that is something that will take longer time, and you will have time to adjust your portfolio to that, and we'll get back to it in these videos as time goes by. That being said, my focus is mostly quantitative and technical when we're looking at the market, but I'm of course not totally removed from the fundamental picture, and having worked inside the industry and knowing the investment banks very well, I can see I've seen the signs before. The last time I saw this kind of market behavior was in 2000, or maybe 1999, 2000, and then again, but not so pronounced in 2007. And we all know what happens in the aftermath to that. When you really can't use Excel or your calculator anymore on some of the companies, and when companies come to the market in a very early phase, receiving an extreme pricing, that's not a sign of health, and the next phase is usually something else. You know, it's like being on a disco. It's at the end of the day when they're just playing, you know, floor filler after floor filler. Everybody is out on the dance floor, drunk, sweaty, and then they start blinking with the lights. You can recognize the behavior and see that the next phase is that the bar is going to close, and it's going to be a long queue for taxis outside. The market can be very strong, longer than you think, and we might be in for, you know, a kind of real blow-off top here before it turns south. But it's just important to remember what kind of phase, what kind of season we are in. And it's like up here in the mountains. Now it's cold, it's February, but the best season for skiing is of course the Easter, when you can feel the warmth of the sun, but that warmth of the sun is also the signal that winter is going to end. So it's just important to be aware of this and to adapt your portfolio accordingly.
Okay, as I mentioned when I was sitting outside, the market is lofty priced. Everything is a bit stretched when it comes to valuation, but I don't really see the technical signs that it's starting to roll over yet. And I'll take you through some what I mean by looking at some charts that I posted on Twitter earlier. This is the Nasdaq 100, the NDX, and of course you can trade the QQQ, the old and popular ETF on that. I actually traded it the first time at the time of this chart back in 1998. So this is 1998, more than 20 years ago, when the Nasdaq was up 85% during that year, and you can see the strong run here at the end, and you can also see what looks like this is a chart of 1 year prices, daily candlesticks. So each blue and red candle here is 1 day of trading. And this is the selection of moving averages that I usually use on a daily chart, which is 200-day, 100, 50, and then 10 and 20-day moving averages. So let's go to the next year. After going up 85% in 1998, the Nasdaq did, the index did another 102% plus dividends. This is not the dividend adjusted index in 1999. So this was quite a run, and as you can see, it was continued to trend rather calmly, nice uptrend for most of the year until it exploded in the autumn. And you can see the fan of moving averages widening out here, and that's something to take notice of. And you can see that the prices are pulling up the 10, 20, 50, 100 and 200-day moving averages, but it's still trading above all of those, so that naturally pulls up prices. And then we came into 2000, which of course you know from history was when things started to happen. It started strong actually. You can see the trend from 1999 continuing here until March, where we started to break down. And of course, by default, the 10 and 20-day moving averages are broken first, and it bounced a little bit after going below the 50. Then it broke the 50 of the 100 and then bounced at the 200-day moving average for a while. And this is fairly large percentage-wise corrections. Then it went sideways for a while. The 200-day moving average held after being tested a couple of times here, but then it broke down. It finally broke down, and this is the process of rolling over that we haven't seen yet in the market. So, and as you can see, it takes months. So this is not something that happens from a day to another, not when it comes to changing general market direction. There might be event-driven shifts like we had in March 2020 when the COVID-19 hit the markets. But then again, it bounced back very strongly and quickly. So what happened after this? Let's just do a couple of other charts. What we see here is in 2001, where the index fell 32% after having rolled over in 2000. And in 2002, it fell another 37%. So from the total top of the market in 2000 to the bottom, the index was down 83%. 83%. And as I mentioned, if you have any kind of leverage in your portfolio, then you will be wiped out. So where are we now? What does it look like? Well, here's the Nasdaq right now. You can see again the fan of moving averages, all trending upwards. The stock had the index had a new all-time high the beginning of last week, and then broke the 10 and 20-day moving average. But it has now fallen down to a support zone right here. You can see the volume at price going back here, large volume zone. And I don't expect it to go down much further yet. And there is no technical sign here for a rollover yet. Not until we at least see the 50-day being broken, and then the 100-day after that. So it kind of, depends. What can you use these kind of comments and input to? Well, if you're a long-term trend investor, adjusting your portfolio of mutual funds, like I am also, I have a portfolio of pension funds. I do nothing. The trend is up and the longer-term moving averages are not broken. From a trading perspective, of course, and what we'll do once we launch the hedge fund is to do much more short-term trading, and these moves are fairly nice percentages to trade on. So that can be done as well. It's possible to trade in various time frames at the same time, and that's something I write about in the book as well. And I think that's a nice thought for all you traders out there to have. That you just have to be conscious in what kind of time frame you're operating, and use the right tools for the right job. And what we see back here, actually, some months back, was when the Nasdaq had a kind of banana-shaped move to the upside. It's an accelerated up move, which I also write about in the book. And many of the components of the index had some even more stellar charts at the time. And that, of course, usually leads to a longer, a more pronounced move back and a longer term consolidation pattern. So this consolidation pattern lasted for several months. You can see the line here, until it was finally broken last autumn. So, but all the time the longer term underlying trend did not come into play. So we can see this kind of moves in some other markets as well. Shanghai CSI 300 in China. You can see a very strong performance for the year, and this very accelerated up move here a few weeks back, and then it went into a sideways motion and then broke to the downside out of this consolidation pattern the last few days. So what might happen is that we can see, of course, a quick reversal, or we can see a little bit more pronounced correction where it falls back to the first level. That's very visible for technical support, which is these former tops that coincides with the 100-day moving average. So, and as for the Nasdaq and tech stocks that I like to watch the most, I can always look at the semiconductor index, which also has an even more pronounced uptrend than the Nasdaq 100, but also has had a little bit stronger correction here. And we see a bearish gap. Actually, we see an accelerated uptrend that starts to fade, roll over, then a bearish gap that's not recaptured. So, but then again, you can see technical support here at the downside, coinciding with the 50-day moving average, and then again at the 100-day moving average down here. So, and the RSI, the momentum index, is already below 50. So I guess at least the first kiss of the 50-day or perhaps the 100-day moving average should be bought. And that's also something I write about in the book. I write about all these kinds of setups, how to identify them and how to trade them. But again, you have to use the right tools for the time frame that you are in, and for longer term trend investors, there's no sign here at all that the long underlying uptrend is broken. We're in good market conditions. We just have to know that the best conditions comes at the end of long up moves. Perhaps this is like 1998, so that we are now entering, or perhaps last year was 1998, so we're now entering 1999, and this will be extremely strong to the upside. But I don't know. So we'll post these kind of comments once a week. Be sure to subscribe, and of course this is the first video, so any feedback is good, and if you like it, if you want to listen to it, any retweet or repost would be appreciated. Have a nice day.